You're watching Money Talk Viewpoint, and I'm Chantel Leeson. Successful businesses have one very common factor, and that is they have an ongoing stream of the right prospects who become clients or customers. And that's good marketing. And that's what we do. Reach out to one of our specialists today at moneytalkviewpoint.org. Let me have our first guest on for the day. And actually, he's our only guest for the day. He's also a co-host on our show. And this is Stuart Kruse. Stuart is a chartered financial analyst, a Quant Investment Advisor, TED Talk speaker, published author, a venture capitalist, and he's the CFO for Virtual Family Office. Stuart, thank you for being a co-host, but thank you today particularly for sharing yourself with our audience. How are you?
I'm doing great. Thank you for that lovely introduction.
You know, you're a virtual family office. Can you share with the audience, they need to understand what is a family office, first of all? And I'm sure that financial advisors who are listening, and there are a lot of RIAs, registered investment advisors who are in a private practice. They don't really know the difference in what it is, but can you explain to us the difference in a family office and then a virtual family office?
Sure, glad to. Great question. So thank you. Family office, I believe it was started with the Rockefellers, right? So they had so much money, they hired financial advisors and estate planners and CPAs and private equity people to manage their money and their investments and to ensure that their assets were basically in the best possible hands and being able to be used efficiently and effectively with all those team members working together, right? Now, when I was managing money, when I first started off, it was just me and I'm just focused on investing. Like I am just investing, like give me your portfolio. I can manage, give me $1 million portfolio. I will manage your money. And that's all I'm doing. And if the CPA called me and said, hey, I need the capital gains and loss report for the year, I would send it to them. But there was no real collaboration, right? So a family office is, I have a family amount of money that is so large that I can afford to hire a team of professionals that are working together in conjunction to make my assets reach its full potential. All right. Now, if you're working with somebody less than, I'll call it $500 million, even $200 or $300 million, like $100 million, you can imagine if I'm hiring teams of professionals, that payroll is going to be in the millions, right? So you can't quite afford to have all those people on board unless you actually have $300, $400, $500 million and up. So for clients that maybe have even 50 million, they can't afford their own family office. So what a virtual family office is we bring all those people together on a platform and give the client access to them on an as needed a la carte kind of basis. So my clients that I work with are generally millionaires, and they certainly don't need the services of a family office 100% of the time. But most of them need some of those services some of the time. They have they might be making more than $1 million a year. So they have tax mitigation opportunities. They might have a bunch of real estate. So they have cost segregation studies that they might need. They might own their own businesses. So they might need to have buy-sell agreements or business valuations in place. They might need premium financing or a variety of other structures that I do not take care of. It's not in my investing lane, but my clients certainly need those services. So a virtual family office is basically, can I provide those services on an as needed basis? And then we pull in the CPA and the estate planning lawyer and whatever experts we need on the outside. And we work together as a team, because me working in my own little silo with a CPA working in his silo is going to be less effective. It doesn't matter how great we are at our individual jobs. If I can get together with the insurance guy and the CPA and the estate planning lawyer, and we can come to a conclusion as what's probably the best for the client. Like I might present an option for the client, and the CPA would say, hey, it's just not going to work for him because of XYZ that you don't even know about. Okay, awesome. Then let's pivot to a better solution. What do you think will work? Well, this might work. Okay, well, we have this other expert that we can bring in. Let's present that solution to the client. And we're working as a team, just as if the client has their own family office in that moment. So that's what a virtual family office is.
You know, the good part about that is that there are a lot of small businesses, and not even that small. They may have 50 to 100 employees who are probably worth 40, 50, 60 million dollars, not at the $100 million level yet. Maybe they're 25 million on their way up the ladder. And that's what happens, is that they piecemeal it.
Yeah.
They have the financial guy over here putting money into a retirement account or whatever else they're doing. They have the insurance guy doing things for him. The CPA does something else, and nobody knows what the other guy is doing. And
Right.
they're afraid to share that advice.
Right. It's so easy to get into that mode of just, I need to protect my little fiefdom, right? And quite frankly, that's how I used to operate. It was much easier. Like if I had an insurance person present something to my client, then I'm losing business, right? I'm just actually losing business, because the only thing that's going to happen is I'm getting assets taken out of my pool of management where I'm billing from, and it goes off to insurance. So what am I going to say? No, go ahead and buy that insurance. I'm going to say, no, it's not good for you. You know, it is the worst thing for you. You should not buy insurance. Now, maybe they have a bunch of kids and they need to have the insurance in case something happens to them, and it is appropriate for them. So in this model, you're bringing everybody on. And same thing, I like have several examples of what you said. And if you're not incorporating and bringing everybody in and working on the solution, then quite frankly, you're probably not doing the best thing or acting within the best interest of the client. And I am, in theory, a fiduciary. And so as a fiduciary, I am supposed to act with the best interest of my clients in mind. But if they're bringing me things that are conflicting to my financial advancement, then I'm conflicted. So what do I do? Well, the best solution now is to bring everybody in. I could argue that if you are not bringing everybody in, that you are not acting as a fiduciary for your client.
Not only is that right, but you'll find the person who's gone to someone who's a CPA, but he also sells insurance and mutual funds on the side, or maybe he's a tax attorney. Yeah. That's not a family office. That's one guy making all the decisions. Some people think, they'll tell me, I've got all that already, and you'll find out he's got one person doing everything, and that you need to have those different minds that work together in a collaborative effort to bring the best results for the client, and that really is the big difference.
Yeah, I mean, think about like, how are you going to be the expert in everything? If you're, let's say, I love to use analogies. You're sick. You're not going to go to a generalist doctor to have your brain surgery, right? I mean, or have your knee surgery. Like you need somebody that's specifically the anesthesiologist comes in, the nurse practitioner comes in, everybody comes in and does their particular job because they're good at it. Now, probably that general practitioner pretty much knows how anesthesia works, pretty much knows how these things should go, but is that what you really want for your assets? You want somebody that's kind of this general practitioner that has a vague knowledge of these things, or do you want an expert? Like the tax code's 75,000 pages, right? And so our experts are experts in a few hundred of those pages. They're just really good at what they do here. So if you're selling your business for $50 million, I may have a good idea about some estate planning tools that you might use, but I'm not going to know exactly what that is the best thing for that particular client. So we bring in an expert in that area. And then to invest the assets that are going into these various trusts, you might have a CPA that knows that you can buy some mutual funds and do an allocation, but are they really going to know how to maximize the returns of that portfolio? I would argue probably not.
Well, let me ask you, one, I want clients to know if you are in that position, don't get stuck there with your financial advisor. Now, I'm not saying don't keep your financial advisor, but we're saying from a broader perspective, look beyond that. And that's why you're looking to Stuart today. Stuart, let me ask you about the mistakes that DIYers do. Do-it-yourself people. What are some of the mistakes they make?
So I'm a big student of behavioral finance, right? I am just fascinated because I have so much math background. I'm fascinated when people act either not in their own best interest or just act unexpectedly. It's fun to see how that happens. And so study after study will show that most do-it-yourselfers underperform inflation, but their recollection is that they do great. So probably some people in the audience are like, that's not me. But when you go and look at their actual performance, what happens is they honestly just have selective memory, right? They remember their winners and they mentally sweep their losers under the rug, and they don't really have an appropriate scorecard. And so what ends up happening is they feel like they're doing better and their strategy is better than what's actually happening. So they end up making emotionally charged decisions. And especially dealing with your own money, it becomes even more emotionally profound for you. And again, lots of studies will say emotional investors tend to fare worse than non-emotional investors. And quite honestly, you can just look through some of the best investors of our time have been diagnosed with, let's say, Asperger's. Like they just have some emotional deficiencies, call it. They just don't make decisions with emotion, and they tend to be better investors. So what happens is do-it-yourselfers will make decisions based off emotion, and they end up eroding so much value of their portfolio that they underperform inflation. So they're actually eating into their own purchasing power. Now their account might be going up, but not as fast as, let's say, inflation. And so they don't really have a good measuring stick for how well they're doing. If they had an advisor, like a professional guy, you could be sure that they were like scrutinizing them very well, but do they put their own scrutiny to themselves? And then another thing I also see is they get very focused in an area. Like best example is tech, right? They want to invest in these fun tech companies, which they should invest in these great tech companies because they are going to change the landscape of our economy. But that is not the only investment option out there. And if you're like, hey, I'm completely diversified because I have Tesla and I have CrowdStrike and I have, Amazon and Microsoft. Yeah, you've got a bunch of techish companies, but you have no real diversification, and they are pretty highly correlated. And then when tech crashes, they get burned considerably. So they tend to not be able to look at anything outside their purview.
Not only that, I think that emotional investors, even though they think they're doing the right thing, they really do get panicky when the market looks bad.
Yeah.
They will run the safety into cash because someone's saying, move your money to cash. And they'll say, well, I've read so-and-so move my money to cash. Well, if you move the money to cash, you may or may not be making the right decision. And then I think that also a lot of emotional DIYers have a herd mentality.
Yeah, very true. That's very true. I think, the joke about economists is why did God make economists? So he can make weathermen feel better about their predictions, right? So you can look at an economist, and if they're all on one side, like, hey, interest rates are going to rise, you can kind of be sure they're going to go the other way. And it's very similar to do-it-yourselfers. If it's just known that X, Y, Z is going to happen, then it's probably not really a great bet. It's probably going to be the opposite. And even if it does happen, you're not going to be rewarded for that risk. If it's all public knowledge, then there's no reward. Just get out of it. So it's often not the best play anyway, even if you're right.
And sometimes what investors do is because they follow other people's advice without knowing what they're doing, they'll buy the wrong stock at the wrong price.
Yeah.
And sell the right stock at the wrong price. We'll end up having a portfolio that looks like a yo-yo. And they'll tell you, but look, I made money. But if you look at the whole picture, maybe you didn't do as well as you could have done if you had the right strategy and the right people behind you.
It's a lot about discipline as well. And again, I'll go back to that behavioral finance. Like one example, I use this, and I'm always curious to see what somebody's going to say, but I'll say the majority of people answer this the way I'd expect. And the question is, if you're buying stock A and stock B, and let's say you bought $5,000 worth of stock A and $5,000 worth of stock B, and the stock A goes up by 10% and stock B declines by 10%. And now let's say you're going to go on vacation and you're choosing to sell one of those stocks. Which stock do you sell? Do you sell A or do you sell B? Now, I'm not going to put anybody on the spot, but maybe for your viewers, just think about this. Would you sell the one that went up and you could say, hey, I took a profit? Or do you sell the one that went down and you're saying, I basically took a loss on that? Now, when I ask this question, and I've asked it a lot, most people say, well, I can't sell the one that took a loss. I have to wait for it to come back because it's going to come back. And I'm going to, as a famous TV personality says, I'm going to ring the register and I'm going to sell stock A and take that profit. But the reality is momentum tends to work. Relative strength tends to work. It's in the math and it tends to work. Doesn't work all the time. But you should sell and cut your losses in stock B. There's a reason why it's in decline when this stock is moving. There's a relative strength issue here. So the most do-it-yourselfers, they tend to say like, I want to notch a win. And I haven't really lost any money yet because I haven't sold this, but they're acting not in their best interest because they haven't done the research. They haven't done the math. And so their ideas are flipped is what happens.
You know, but also I think that a lot of people get the wrong advice overall because they're taught to keep their losers because they know they'll go up eventually. And they're taught to take profit off their winners. Why would you sell something good?
Yeah.
Just hold on. I mean, one thing Buffett does, he buys quality and keeps it.
Keeps it for a really long time.
Yes. But people do invariably, though, they'll buy quality. It'll go up and say, okay, I've made my profit. Let me get out of it. Why are you getting out of it?
I use a bunch of analogies. So a favorite analogy is, especially if somebody doesn't watch or like football, and I'll say, do you know anything about football? And they're like, no, I hate that sport or whatever it is. And I'm like, okay, great. So that's perfect. But you do know football exists, right? And they're like, yeah, okay. I'm aware that it comes on every Sunday and Thursday and sometimes Monday and whatever. So I'll say, if I had to ask you which teams are going to do better in this coming season, the teams that made the playoffs last year or the teams that didn't make the playoffs last year, as a group, which do you think is going to do better? The teams that did really well last year or the teams that didn't? Like the teams that didn't, are they going to regress back to the mean and just all of a sudden do great? And the teams that just really did well, you know, they're just going to fall off and it's going to be kind of a flip-flop. They're like, well, no, the teams that did great are going to keep doing great. Yeah. And why is that? I don't know. Yeah, you don't even need to know. You don't need to know. It could be the coach, could be the players, could be youth, could be the offense, could be the defense. You don't need to know. But you do know they're going to outperform. And so the analogy is we bet on the stocks or the companies or the sectors that are making the playoffs until they stop making the playoffs. It's a relative strength thing. It's a pretty easy analogy that works in stocks. It works in companies. It works in countries. It works in sectors. But eventually the stock will stop making the playoffs. And then there's a relative issue with that. And you kind of step back and say, I don't necessarily need to be playing or betting on that team anymore. Don't get married to that team. Like it's not your home team. Like I'm a Pittsburgh Steelers fan, which I probably lost a bunch of like listeners for that, but I've known the Steelers since the 70s and just love the like terrible towels. And I was a receiver growing up. So Lynn Swann and John Stallworth, they were kind of my heroes and everything. They're not going to make the playoffs this year. So, you know, but I'm still going to be a diehard fan because they're the Steelers. But don't treat your stocks like that. Don't treat your investments like that.
I think the bottom line is, particularly for the DIYers, just do a little homework and find the right people.
Yeah.
And just do a little homework. And that's why we're on this show today. So they can meet you and meet me, but you can find that by looking around. Somebody who knows what they're doing.
100%.
Listen, KAM is Kruse Asset Management. What's the market forecast? And what should the investors do now?